Hello investors and traders. Today we'll speak about 3 dividend stocks with a stock price less than 50 bucks and the dividend yield at least 4%. And let's start with the first company. It's Altria. And with nearly half of the US cigarette retail share, Altria dominates the market. The company's premium Marlboro product is the top selling cigarette brand in the country, according for the vast majority of Altria's total cigarette market share. But for consumers, they are on the tight budget and more susceptible to switching to cheaper cigarettes in a recession. The company has discount cigarette brands as well. Let's check its fundamental parameters of Altria. We can see that the total score is 78, quite high mark. Its financial stability, we can see that debt to EBITDA ratio is 3, not so high and not so low. Generally it's okay, and the interest coverage, yeah, it's quite impressive. It's 10. It's telling us the operational income is in 10 times higher than the interest company paying every year. So any problems with debt for the company and the Altman, the score by the way is higher than 3, so the probability of the default for the future years for Altria is very low. The profitability, we can see the gross margin is 67, net margin is 22, so it's in my mind highly marginal company. The value P/E ratio is current is 17, and the forward please pay attention, only 8. So then was expecting the income of its company to grow most probably. And by the way, PS ratio less than 4, so in my mind it's not expensive stock at all. And let's have a look on the dividend. Yeah, dividend yield very expensive. Dividend yield is more than 8%. Yeah, it's very high dividend yield. The 3-year dividend growth rate is more than 5%, and also the company perform share buyback of its stock. So in this case we can see that its stock support for its stock share. And let's have a look on the chart of Altria. So in my mind, yeah, instead of Elliott wave theory, I think it since 2007 it was the first wave, then the second, the third usually the largest wave in the impulse. Here we had a correction. In my mind, here is finished. By the way, it was the COVID lows, the pandemic lows, and now I'm expecting to see the fifth wave. The fifth wave is usually higher than the 3, so the target is at least 80 bucks per share. So in this case, we have a nice potential to grow at least 60-70%. I continue to hold this stock in my portfolio, as Altria is one of my dividend stocks that I'm continue to hold. If you like this video, don't forget to subscribe to my channel. I have a lot of videos about the dividend stock, US stock market, and other interesting stuff. The next stock is Enterprise Product Partners. If you live in an economically developed country, you likely own a smartphone. Among other consumer goods, use electricity and heat your home in the winter months, and none of these amenities would be possible without crude oil, natural gas and petrochemicals. With more than 50,000 miles of pipeline infrastructure throughout the US to store and transport natural gas, crude oil and petrochemicals, Enterprise Product Partners is the ever important middle Lorman between production companies and refiners. While alternative energy sources will increasingly be used in the future across the world, overall energy demand will be also increased as more join the ranks of the middle class. This means that natural gas and petrochemical will likely be as important in 20 years as they are now. Let's have a look on the parameters of EPD. Yes, EPD, its ticker, its total score 86. So current, we see that the debt to EBITDA 3, interest coverage is not so high as for the Altria, but still it's generally it's okay. So the marginality not so high as Altria, but it's still profitable company. We can see that the company still have net income. Yeah, by the way, last let's check. Yeah, last years, last 10 years, it has been all the time profitable company. So it's a very good sign. So let me check the value. The value P ratio 10. Oh, it's very cheap stock. Forward is even lower than 10, and the PS is only 1. It means that for $1 you can buy $1 of its revenue. So PS 1 and net income about 10. So yeah, it's my mind very cheap stock. And let's move to the dividends. Yeah, dividend yield is more than 7% now. The payout is also less than 1, so the company even increase its dividend payment. And also the last 3 years the company continue to grow, to show growth in its dividend payments. Let's have a look on its chart. It's a weekly chart here, so we can see in my mind here we have a increasing channel. It was the first wave, the second, the third. Here I think the fourth wave finished, and now we are in the fifth wave. My target is somewhere here in the higher border of this channel. So most probably we have a nice probability to see this stock about $30. In this case the growth potential is about 20%. So why not? We have a nice dividend, nice coverage of it debt by the operational income. And by the way, this company is from a very nice and very attractive sector for now. So these are the reason that I'm still holding this stock. And the last stock for today is VICI Properties. A recent survey of consumers found that 76% rather spend on experiences that on material possessions, and VICI Properties portfolio of 43 gaming properties and 4 championship golf courses leased out to tenants help consumers to make memories that will last a lifetime. The company's property portfolio includes the world renewed Caesars Palace Las Vegas and Balgata in Atlantic City. Thanks to the iconic nature of VICI Properties, Las Vegas-based and regional properties, the company boasts a 100 occupational rate, coupled with the fact that about 100 of its lease will include rent escalators linked to the inflation bond by 2035. The company's adjusted fund from operation, also called as FFO, per share should grow over time. The company targeted dividend payout ratio of 75% should also build a margin of safety for the dividend, and investors can snatch up the stock's appetizing 4.8 dividend yield at the current share price of $30. If we look at the chart, so by the way, here it was the best time to buy the stock. We can see the momentum indicator, the RSI was even 22, 23 on the weekly time frame. Now it's a little bit higher, but anyway, here 27, it's here the major support level. Now I traded higher than this level. I think that everything is higher this level. You can at least consider a stock that you can to buy. Everything that's lower is can be very dangerous. So VICI in my mind can be very attractive stock for you. The market cap is more than 30 billions. P ratio is about 30, so it's not cheap stock. But we can see that the last years, it's still in last 5 years it continued to be profitable company. Now it's margin is about 60%. Let's have a look on the earnings. EPS for the future years expected to be stable, and the revenue let's move to the annual basis. Yeah, it supposed to even to grow, because last year it was 1.5 billion. This year expected to be 2.5, and then in a few years it will be, no, at least expected to be more than 3 billions. So in this standpoint of view, by the way, please pay attention. The dividend of this company very stable. Last 4 years it stable 4.5% of dividend yield. So for me, company from the real estate sector, like real rate, it's rate. I remind you that real estate investment trust in the US. So why not? At least it very cheap stock. The dividend is quite impressive, and the forecasts are very good for this stock. So if you like this video, don't forget to subscribe to my channel, press the like button, and see you on the next time. Bye.